Welcome back to the Deep Dive. It is Thursday, January 29th, 2026. And if you have been glued to your terminal today, you're seeing a lot of green.
A lot of green.
The internet content and information sector is, well, it's rallying hard. And if you just look at the headline numbers, you'd think it's a party for everyone. But if you look a little closer, this really isn't a rising tide lifting all boats.
No, not at all. It's more like a tsunami that the big ships are surfing and, the smaller boats are just capsizing in. We are seeing a pretty brutal bifurcation today.
Bifurcation, that's the word for it.
Yeah, the theme isn't just tech is up. The theme is that the Magnificent Seven, and specifically the ones who own the AI infrastructure, they're becoming utilities, while the challengers are being forced to make some very painful pivots just to stay relevant.
That is exactly what we are going to unpack. We are running a journalistic stock screener report today, focusing on 3 specific tickers that tell this story of the AI divide perfectly. Meta Platforms, Alphabet, which, let's be honest, we are all still calling Google and Pinterest. We're going to break down the news, the financials, the technicals, and, of course, we're going to run the paper money math to see what these moves actually look like in a portfolio.
And the paper money segment is going to be particularly telling today because we have 3 very, very different timelines to look at. We've got the overnight pop, the long-term compounder, and the falling knife.
Oh, all right. Before we start counting our virtual profits, we have to get the housekeeping out of the way. While we are going to be discussing specific buy and sell triggers, looking at RSI levels, calculating potential returns, this is strictly for educational and entertainment purposes.
Right. We are not financial advisors.
Do not take this as financial advice. Please do your own research.
Yeah, the market is volatile, especially during earnings season. Don't trade money you can't afford to lose based on a podcast.
All right, let's launch into the company that is sucking all the oxygen out of the room today. Meta Platforms, ticker Meta.
Victory lap.
It certainly feels like one. The stock closed today at $738.31.
Wow.
That is up 10.48% in a single trading session. In dollar terms, that is a jump of $69.58. For a company of this size, moving almost $70 in a day it's violent.
That's massive. And we know the catalyst was the Q4 earnings beat and, the strong guidance for Q1 sales. But the headline number isn't what interests me.
Oh.
What interests me is what they are spending to get there.
Oh, you're talking about the CapEx. I saw the number and I thought it was a typo. They are guiding for capital expenditures of up to $135 billion.
$135 billion.
That is the GDP of a medium-sized country.
It's a staggering amount of money. I mean, think about it. In 2024, 2025, if Mark Zuckerberg had announced he was lighting $135 billion on fire for infrastructure, the stock would have tanked 20%.
Oh, investors would have revolted, absolutely.
But today, they're cheering it.
So why the change? Why the change in sentiment? Why is the market suddenly okay with this level of spending?
Because the AI payoff is no longer theoretical. For a while, AI was just a cool chatbot or, a way to generate images. But Meta has successfully integrated it into their ad stack.
Right.
They aren't just serving you ads based on what you clicked yesterday. They are building a predictive engine that knows what you want before you do. That $135 billion isn't for the metaverse. It's for servers that make their ad machine incredibly efficient.
So the market sees that for every dollar they spend on chips, they're getting, what, $2 back in ad revenue?
At least. The money printer is actually printing faster than they can spend it.
Wow. Let's look at the financials that support that. We are looking at a market cap of $1.86 trillion. They are knocking on the door of the $2 trillion club.
And the margins explain why. Gross margin is sitting at 82%. That is the beauty of software, right?
Yeah.
Once you build the platform, the cost to serve the next user is negligible.
Almost zero?
But the return on equity, the ROE, is 30.24%. That is just a gold standard for efficiency at this scale.
Okay, but let's play devil's advocate for a second. The stock is at an all-time high. The PE ratio price to earnings is 31.42. That feels expensive. Are investors paying too much for this growth?
Well, on the surface, a 31 PE looks pricey compared to the S&P 500. But you have to look under the hood. This is where the PEG ratio comes in, price earnings to growth.
Right.
Think of the PE as like the sticker price of a car. It looks high, but the PEG tells you the performance. If that expensive car gets 100 miles to the gallon and goes 0 to 60 in 2 seconds, it might actually be a bargain.
I like that analogy. So where does Meta land?
Meta's PEG is 1.15. Generally, a peg around 1.0 is considered fair value.
Hmm.
So despite the stock being up 10% today and looking expensive on a PE basis, the peg suggests it's actually fairly priced relative to how fast they're growing earnings.
So the market is saying we will pay a premium because you're growing like a startup despite being a trillion-dollar giant.
That's it exactly.
Let's shift to the technical analysis, the TA. The chart just looks like a rocket launch today. We had a gap up of 10.36% at the open.
It left a huge gap on the chart. Now, momentum traders are looking at the RSI, the Relative Strength Index. It's currently at 73.75.
And conventional trading wisdom says anything over 70 is overbought. Does that mean we should be selling right here?
That's the textbook answer, yes. An RSI of 74 suggests the buying frenzy is a bit stretched. However, in a strong momentum trend, especially after an earnings breakout, stocks can stay overbought for a long, long time.
It's called embedding, right?
Exactly. It's called embedding. But, caution is warranted. The stock is trading well above its 200-day simple moving average, which is trending up 8.5%. The long-term trend is undeniable, but buying right here, right now, you are chasing.
Well, let's put a dollar figure on that, Chase. It's time for the paper money math. We're doing the $5,000 challenge.
Let's see how the earnings gamblers did.
Okay, scenario. It's yesterday afternoon, Wednesday. You had a hunch. You ignored the risk. You ignored the advice to not play earnings, and you bought $5,000 worth of Meta at the close of 668.73.
A high-risk maneuver.
For sure. You would have picked up roughly 7.47 shares. You woke up this morning to that 10.400% pop.
Boom.
In one single trading day, your profit is roughly $520. Your account is now sitting at $5,520.
That sounds great, right? Quick money. But the lesson here isn't the $520, it's the psychology. Most retail investors panic sell the moment there is uncertainty. To make that 520, you had to be willing to lose 500 overnight if the guidance was bad.
That's a great point.
That profit is the premium you earn for having nerves of steel, not just for picking a ticker.
Well said. High risk, high reward. Now let's pivot to a company that takes a different approach. They aren't as flashy, but they are arguably even more powerful. Alphabet Inc., ticker GOOGL.
The quiet giant.
Quiet is the word. They closed at 338.25, up at just 0.67%. I mean, compared to Meta, that looks boring.
It does. But the news flow today is arguably more significant for the long-term structure of the tech industry.
You think so?
Ooh, I would argue the news today is historic. We finally got confirmation of the rumors. Google's Gemini 3 AI is going to power the upcoming Siri upgrades on the iPhone.
This is a huge deal. I mean, for years, Apple and Google were mortal enemies in the smartphone wars. Doesn't this feel like a capitulation from Apple?
It absolutely is.
Yeah.
I've been calling it the capitulation of Cupertino. Apple essentially admitted that they cannot compete in the large language model arms race. They're outsourcing the brain of the iPhone to Google.
Wow.
For Alphabet, this secures their dominance. They are now the default AI layer for both Android and iOS. I mean, that is a monopoly position in everything but name.
And it's not just software. I saw Waymo, Alphabet's robotaxi unit, is making moves too. They've started service to San Francisco International Airport, SFO.
And that is significant because airport runs are the highest margin trips in ride-sharing. It's steady, high-value business travel. By unlocking SFO, Waymo is moving from a science project to a legitimate threat to Uber and Lyft's most profitable routes.
So, okay, we have the Apple deal, the Waymo expansion. Why did the stock only move 0.67%? Why isn't this up 10% like Meta?
Timing. It's all about timing. Alphabet reports earnings on February 4th. The market is in wait-and-see mode. Investors are terrified of a surprise, so they aren't going to bid up the price until they see the actual numbers.
So the good news is priced in, but the earnings risk is keeping a lid on it.
Exactly.
For now.
Let's look at the sheer scale of this company. Market cap is $4.08 trillion. It is the biggest of the three we are analyzing today.
It's a fortress. And the metric that really matters here is the cash. They have cash per share of $8.16.
So for every share you buy, you are essentially buying $8 of cash sitting in a bank vault. Exactly. It gives them a safety net that no other company really has. And look at the profitability. ROE is 35.45%. That is even higher than Meta. They are incredibly efficient at turning shareholder equity into profit, mostly because their search business is the greatest business model ever invented.
Valuation-wise, the PE is 33-37, a little bit higher than Meta.
It is. But you're paying for safety. You're paying for that $4 trillion stability.
Okay, let's check the charts. What is the technical analysis saying?
This is a classic bottom left to top right chart. The stock is up 73.20% over the past year. It is trading right near its 52-week high of 340.49.
And the RSI, where's that at?
RSI is at 66.09. Now, this is interesting. It's strong momentum, showing bulls are in control, but it's not yet at that overbought 70 level.
So there's still room to run.
Technically, yeah, there is still room for this to run before it gets overheated. Plus, the 200-day moving average is up almost 45%. This is a very strong, very healthy uptrend.
Okay, let's do the paper money math on this one. Since Google is less volatile, let's look at a longer holding period.
The compounder view.
Scenario. You decided to invest your $5,000 exactly 1 year ago today. You weren't trading earnings. You just wanted to own the best tech company in the world.
Buying quality and just going to sleep.
Based on the pricing from a year ago, you would have picked up roughly 14.78 shares. You held through all the antitrust noise, all the AI fears. Today, your performance is plus 73.20%.
Which beats almost any hedge fund out there.
Your profit is roughly $3,660. Your total account value is now $8,660.
And this just illustrates the difference between trading and investing, right? With Meta, we talked about the stress of the overnight earnings hold. With Google, you made nearly double your money by simply recognizing that they are a dominant monopoly and doing absolutely nothing for 12 months.
That is the power of compounding on a winner.
It is.
Unfortunately, not everyone in the sector is a winner. We have to talk about the company that is stuck on the wrong side of this AI divide. Pinterest, ticker PIS.
Yeah, the mood changes significantly here.
Pinterest closed at $22.35. It's down 0.93% today, which doesn't sound too bad.
Right.
Until you zoom out and realize it has dropped nearly 13% in the last week alone.
It's ugly. And the news driving this is what people are calling the AI pivot, which is becoming a corporate euphemism for we are in trouble.
The headline is that Pinterest is laying off 15% of its workforce.
Right. And the company line is that they are pivoting resources to AI.
Translate that for us.
It means they are firing humans to buy GPU chips. Here's the reality. Meta and Google have enough cash to hire the best engineers and to buy billions in hardware. Pinterest does not.
They have to choose.
They have to choose. To afford the infrastructure necessary to compete in an AI-driven ad market, they have to cut their headcount. It's not a pivot from strength, it's a pivot for survival.
Let's look at the financials to see if this is a sinking ship or maybe a turnaround play. Market cap is $15.1 billion. Tiny compared to the others.
It's a minnow. But here is where it gets tricky for value investors. The PE ratio is only 7.74, and the PEG ratio, it's 0.66.
0.66. We just said anything under 1 is a bargain. Does that mean Pinterest is the deal of the century?
That is the trap. A PEG of 0.66 screams, buy me. It suggests the stock is dirt cheap relative to its growth. But you have to ask why it's cheap. Look at the margins. Gross margin is 80%. That's great, same as Meta. But the operating margin, it's 6.91%.
Wow. Wait, so Meta's running at 40+%, and Pinterest is struggling to squeeze out 7%.
That's the problem. They are inefficient. They are spending huge amounts of money just to keep the lights on and the users engaged, but they aren't converting that into profit effectively. So is it a bargain bin opportunity? Maybe. But it looks a lot more like a value trap. A stock that looks cheap but just keeps getting cheaper because the fundamentals are deteriorating.
Let's look at the chart. Is there a floor anywhere?
It's what we call falling knife. The stock is trading way below its 200-day moving average, which itself is sloping down by nearly 29%. It's hovering right at its 52-week low of 2250. It is testing the absolute bottom.
The RSI is sitting at 26.93. Now, technically, under 30 is oversold.
It is deeply oversold.
So isn't that a buy signal?
For a very aggressive trader looking for a dead cat bounce, maybe. But RSI can stay oversold for weeks while a stock grinds lower. Buying here is betting that the bad news is over, but with layoffs just announced and the business model under pressure. That is a very dangerous bet.
Let's do the math on that dangerous bet, the $5,000 challenge.
This one is going to hurt.
Scenario. 3 months ago, you looked at Pinterest and thought, it's down, it has to come back up. You bought the dip, you put in $5,000.
The classic, it can't go any lower thesis.
You picked up roughly 223 shares, but instead of bouncing, the stock kept sliding. The performance over this quarter has been negative 32.68%.
Ouch. That is a portfolio killer.
Your loss is roughly $1,634. Your $5,000 is now worth just $3,366.
And this is the opportunity cost of trying to be a hero. While Google investors made 70% doing nothing, the Pinterest bargain hunters lost over 30% of their capital. It highlights why trend following, buying strength like Meta and Google often outperforms buying weakness.
So if we step back and look at the stock screener as a whole today, what is the synthesis?
The synthesis is that AI is an accelerator, but it accelerates everything, both success and failure. For Meta and Google, AI is driving massive CapEx, but it's also driving massive revenue and monopoly power. They are entering the stratosphere.
And for the rest?
For the mid-cap players like Pinterest, AI is an existential tax. They have to pay it to play, but they don't have the scale to monetize it yet. We are seeing a divergence where the mega caps are becoming, almost like sovereign entities, and the smaller players are shrinking just to survive.
I want to leave our listeners with one final thought to chew on tonight. We talked about those PEG ratios.
The 1.15 versus the 0.66.
Exactly. We have Pinterest at 0.66, technically a screaming buy for value investors. We have Meta at 1.15, technically fair or maybe slightly expensive, but look at the price action.
Meta's up, Pinterest is down.
In this market environment, does value investing even matter anymore? Or has the market structure fundamentally changed where momentum and AI dominance are the only metrics that count? Are we ignoring the bargain at the bottom with Pinterest because we are blinded by the stars at the top, or is that bargain actually a mirage?
That is the multi-billion-dollar question. If you believe in mean reversion, you buy Pinterest. If you believe in the AI singularity, you buy Meta.
Something to think about as you check your own portfolios tonight. That's it for this deep dive into the internet content giants. Check those charts, watch your paper money, and we will catch you tomorrow.
Stay curious.